Hello, everyone, and good evening. I know most of you are watching the Broncos game, and I got on my Broncos colors, but we will jam through this tonight. And tonight's presentation is really designed to be pretty fun. I'm just going to give 50 visuals that every investor should memorize. Before we begin, I just have to start with some formalities. Hello, everyone, and welcome to our presentation this evening. Tonight, we are going to cover 50 visuals every investor should memorize. Unlike other presentations, this presentation is meant to be a little bit of fun. We'll kind of work through some great little graphs that we put together for everybody and unpack a few things. So, the first thing that I'll start with are our disclosures. Triumph Capital Management is an independent firm with advisory services offered through Triumph Capital Management. Tonight, I'll be making some forward-looking statements as well as looking at some historical information, all with some charts. What I want to make sure that everybody understands is historical returns are no guarantee of future returns. Sometimes we do this presentation live, so the next slide really doesn't apply to you. But before we jump into it, a little bit about myself. My name is Derek Eichenwald. I have the distinct pleasure of serving as CEO of Triumph Capital Management. At Triumph Capital Management, we are located, our home office is in here, Denver, Colorado. We have offices up and down the Front Range, as well as on the West Coast, California, so on and so forth. Your questions are welcome because we are not in a live setting. If you have any questions, feel free to email, feel free to reach out, feel free to send a smoke signal, any way that you'd like to go. Again, tonight's presentation is really designed to be somewhat fun, share some great graphs with you, so on and so forth. So without further ado, let's go ahead and get into it. The first thing that I'll start with is, in the long run, stocks win. What you're looking at here is you're looking at a graph that goes back from 1926, so 96, 97 years at this point. This graph goes from 1926 until 2001. The two lines at the top, the two blue lines, represent the stock market. The light blue line basically represents the S&P 500, while the dark blue line is looking at the Russell 2000. Another way to say that is that light blue line is looking at large cap stocks here in the United States, while that dark blue line is looking at small cap stocks, so smaller companies. What this is showing you is had you invested $1 in 1926 inside of those indexes, what that $1 would have been worth at the end of 2021. That $1 invested in 1926 in small cap stocks grew to 56,000. Well, that same $1 in large cap stocks grew to $14,000 if in the S&P. Down below, you have the orange line as well as the green line. The orange line is representing government bonds, while the green line is representing government bonds as well, but what are called treasury bills. Lastly, you have the inflation graph. This is simply showing you what $1 would have purchased you back in 1926. At the end of 2021, beginning at 22, that same $1 needed to grow to $16 just for you to have the same amount of purchasing power. Now, often investors will say to themselves, hey, I hear that the stock market does about 10%. Where does that number come from? That number comes from this graph. As you can see here, large cap stocks over time produce on average a 10% rate of return. That is not to say that the stock market goes up by 10% every year. Obviously, you have big down years followed by big up years. When you average all that stuff out, that's where that 10% market return came from. I love the words of Mr. Warren Buffett, and here's a famous quote. I will tell you how to become rich. Close the doors. Be fearful when others are greedy. Be greedy when others are fearful. Um, by the way, stocks don't always produce something. What you're looking at here is the number of days, in some cases, that go by without reaching a prior high. In other words, sometimes people think, hey, they go to invest in the market, they put money in at the beginning of the year, and geez, by the end of the year, it should double or something like that. Sometimes with stocks, you get nothing. It is a waiting game. We'll show you some more graphs about that. Moving right along, because obviously I got about 50 to look at. What you're looking at here is the daily historical performance return of the S&P 500 from 1942, okay, until basically current date, And what you're looking at here is those blue areas are showing you how long the average bull market lasted, and then how long the average bear market lasted. A bull market is a market of upside return, while a bear market is a time of downside return. For simplicity of your eyesight, I'll focus on the first graph here. What this is simply saying to you is from 1942 until 1945, which, but basically about 4.1 years, you had a return inside of the market, a cumulative return of 157%, annualized return of 26%. Obviously, that was followed by a bear market. That bear market lasted 11.6 months, and 28% was lost cumulatively. You can see a very long bull market here from 87 until the dot-com bubble burst at the end of 1999, a 12.3 run. But anyways, if you average all of these out from 1942 until current date, you basically have a bull market that on average lasted 4.4 years with a cumulative total return of 155%. The bear market period lasted on average 11 and a half months, and the cumulative loss in that bear market was 30%. Therefore, you get the title of the slide, you make more in bull markets than you lose in bear markets. And of course, that's why you saw markets go up over time. If I take that data and I crunch it a little tighter, and I look at annualized returns from 2012 until the beginning of 2022, so the end of 21, 10-year annualized returns. What you'll notice here is over that time period, the S&P 500 was the winner, an annualized return of 16.6%. That was followed by small cap, so that dark line we saw when we went all the way back to 26, which produced a 13.2% rate of return. You can see what real estate did. What a 60-40 means is 60% in stock, 40% in bonds. By the way, you can see what the average investor did. What I mean by the average investor is I mean a retail investor. Why did the retail investor only do 8.7 versus what the S&P did at 16.6? We'll chat a bit about that. As I go down the trough here, you can see developed market equities. So that's going to include the US as well as developed international. You see what a 40-60 portfolio did. In other words, 40 inside of stock, 60% in bonds. You can see basically what homes did around the United States of America, high yield bonds, emerging market bonds, Brazil, Russia, India, China. You can see what the bond market did on average, what inflation was, what cash earned you, and lastly, what commodities did over that same period of time. Moving right along here, again, this presentation's the 50 charts that every investor should be aware of. So markets move in cycles, big booms followed by busts. And funny, so do investor emotions. So most of you have seen this chart before. Depending upon the timing, one goes to invest, they start to see their money going up, their excitement going up. They're thrilled. Maybe they invested 100 grand, it's worth 150, and before you know it, it's worth 175. And then we get into one of those flat markets where really nothing is happening. And, maybe you get a little anxiety, right? You haven't seen the account grown. How can this be? You now start to see it go down, and fear then starts to set in. Depression, what should I do? Panic, I give up. Hopelessness, depression. But we start to see things come back, and that cycle happens all over again. When markets are up, okay, my phone starts to ring. People say, hey, Dirk, I found another 100 grand sitting in my desk drawer. I think I should invest it. Why? Because they're seeing their statements go up. When they see their statements go down, people say, oh my God, I need to sell everything. The way that we look at this, the way that professional asset managers look at this is when we see this occurring, we look at it like a point of maximum risk, right? It's probably time to take some of those chips off of the table. We'll unpack via graphs why that is. When we see markets going down, we look at this as max opportunity. I like to use that quote again from Warren Buffett. He says, be fearful when others are greedy and be greedy when others are fearful. It's exactly what this graph is describing. However, I'll entertain you with another quote by Ben Graham. That quote is, the individual investor should consistently act as an investor and not a speculator. It is important to understand that we as human beings are absolutely, positively, 100% herd animals. I know we like to believe that we are not, but we are. This is a cartoon that was printed in the Wall Street Journal. As you can see, it starts out, I got a stock here that could really excel. Really excel? Excel? Sell, 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 sell? This is madness. I can't take it anymore. Goodbye, goodbye, bye, 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 bye. We're herd animals. Some of you have heard of the Dunning-Kruger effect. What is the Dunning-Kruger effect? It's a psychological study. It was summed up, I think, perfectly by a British comedian by the name of John Cleese, who once summed it up by saying, if you're really, 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 really stupid, then it's impossible for you to know that you're really, 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 really stupid. I guess what this is saying is we as human beings, study after study shows this, that when we have low confidence inside of something and they test us on it, we tend to present that we have a high level of confidence. In other words, of course I know everything. As we start to determine that, hey, maybe I don't know everything about this. Oh, maybe there's more than I thought. And then, hey, I may never understand this. To some flattening, it's finally starting to make sense. And, as we start to figure things out, we start to get a higher degree of confidence. I'll tell you a quick story about this slide. I had no idea I was going to tell this story until last night. Last night, I got a call from a friend of mine that I've had since childhood. This gentleman's probably one of the smartest people that I know. He became a professor at Stanford, I think at the age of 33, unbelievable. He doesn't teach math, he doesn't teach finance or anything like that. I actually forget what he's a professor in. It's not part of the story. I probably need to polish this up a little bit. But he was asking me a bunch of questions about the stock market. Now, of course, I've been doing this for 22 years. And I'm explaining things to him, and he's asking very high level, very intelligent questions. And midway, I was on the phone with him till 1 o'clock in the morning. He called me about 9:30, and I talked to him about 1 o'clock in the morning. That's how in depth we got in the conversation. He said to me midway through the conversation, wow, I guess I really don't understand this. I'm talking about a gentleman who became a professor at Stanford and throughout all of our school, without a doubt, was the smartest person in the entire school, without a doubt. Valedictorian, the whole nine. Let's keep moving along here because this slide's not that entertaining, but let's keep moving along here, okay? Here's something interesting. The worse the unemployment rate is, the higher future returns of the market normally is. Wait, what? You mean to tell me when employment is higher, unemployment is higher, the stock market tends to do better? Well, yeah. Look at this chart. This is simply showing you the S&P 500 average returns by the unemployment rate. When the unemployment rate is 9% or higher, we tend to have over that next 1 year a 21% rate of return. Obviously, when I show you the 5 and 10-year numbers, that's all reflecting off of that. So why is that? You would think completely the opposite. Today, our unemployment rate is very, very low. Today, our unemployment rate, I believe, is at 3.5%. Remember, the government or the Fed would really like unemployment around 4. Okay, they find that 4% unemployment is that perfect porridge, not too hot, not too cold, right? When you think about it, how is the stock market driven? The stock market is driven over the longer term by profits of companies. So when you have more people working, you have more people spending money, and therefore that should lead to profitability of the market. Generally speaking, when you have unemployment rise, okay, you have less people spending money, and that's absolutely true. So this chart is a little bit deceiving, but when you get to an unemployment rate of someplace between 9 to 12, that's generally indicating a peak, and the market's sold way down, okay? And what comes from that is you have a Fed that's easing interest rates because they want to make money cheaper and therefore spark the economy. The unemployment rate starts to go down, and these companies that have been sold off greatly, their stock market's a future looking indicator. So it says, geez, there's now more people working because you have an unemployment rate coming down, and therefore corporate profit should go up. So just point this out, you know, to make a point there. There's always smart sounding reasons to sell. This chart is showing you March of 2009 to June of 2020. Let's take a look at some of the headlines. A big BP spill, right? When that happened, oil prices should go up and stock prices should go down. That was followed by the flash crash. If you remember that, it was about a week. I remember it, I worked through it. You know, a few months later, you had a U.S. stock falls by 20%. Stock market sold off by 20% in the course of, you know, a few weeks there. That was obviously September 11th. You can continue to look at these different headlines. U.S. government shutdown, Ebola virus, you know, U.S. election, Brexit. VIX hits an all-time low, meaning very low trading volume on the indexes. We enter a bear market. Dow falls 1,175 points. It was the biggest point decline ever back in 18, okay? We then even got into coronavirus. We got into a trade war with China. We got into technically a bear market inside of the S&P 500. What this black line represents is what the S&P 500 did over that period of time. Believe it or not, the cumulative return over that period of time, March of 2009 till the end of June of 2020, was 495%. Working off the theme that there is always a reason to sell. And especially as we get into the season, the political environment, right? Depending upon what side of the aisle that you fall in, my phone rings. Geez, Derek, I can't believe this president or that president. I can't believe we elected him. Isn't the market gonna sell off? Isn't it gonna be the worst thing in the world? Well, if you go back to 1961 when John Kennedy was elected, had you invested $10,000 into the S&P 500 and completely ignored politics or completely ignored every headline, okay? When you got to June of 2020, that $10,000 was now worth $3,148,529 with it fully invested 100% of the time inside of the S&P 500. What this chart is also showing you is it's showing you the rate of return during that president's reign. So you see Kennedy Johnson, that reign that lasted, you know, almost a decade. The annualized return over that period, take a look at it. You then see that followed by Nixon and Ford. And then you see Carter. Everyone says the Carter years were really horrible. I understand we had record inflation, so on and so forth, but look at the S&P 500 over that 4-year period of time, annualized 11.7 per year. The go-go 80s, Reagan, 14.2 per year, followed by Bush up until 93. 15.7, Bill Clinton. George W. Bush was the one time, back-to-back president, but don't forget we had 9/11 that occurred inside of there. And also, if you will let your eye follow it, this was right towards the end of the presidency, and this was the global financial crisis, followed by President Obama, and then followed by Trump. It is not, what I'm not pointing out here is a lot of times people will make things political and they will somehow do the math on this and deem that the Democrats had a better market or the Republicans did. And even if one of them did or one of them didn't, they'll say, well, that's because they adopted the policies of the other party when they got into office. That is not the point that I'm trying to make here. The point that I'm trying to make here is erase all those presidents' faces and simply look at that graph underneath there by the S&P 500. Okay, let's keep working. Another graph. Behavior is everything. Behavior is everything. Dalbar does a lot of quantitative analysis studies. And what they are showing you here is they are showing you, had you invested $100,000 on 12/31 of 2010, 12/31 of 2010, what would that money be worth 20 years later? And what they found when they looked at this is they said, hey, the investment returns of investing, again, in the S&P 500, you had an annualized return over that period of 9.14. Your $100,000 grew to 575. However, when they look at individual accounts of people running their own money, so they are able to get data from E-Trade accounts or accounts. When one opens up account, it is a known thing if it is considered a retail account or an institutional account. When we open up accounts for you, it's looked at as an institutional type of account because you're hiring a firm to run it for you. If you were to open up an account on your own, it's looked at as a retail account. And you can see the retail account investor, they, over that 20-year period of time, they doubled their money, but they only did 3.8. When you come over here to the bond market, you can see what the index did versus the individual investor inside of the bond market. There are reasons for that. We'll unpack some of them. But again, remember tonight, as I mentioned earlier, just a little bit of fun looking at some charts here. One thing that I will say is when you are an investor, if you'd like to increase your odds of success, okay, if you'd like to increase your odds of success, the answer to doing so is increase your holding period. What do I mean by that? And so Morningstar in this situation, they went back and they looked at what happened if an investor was only willing to invest for 1 year, 5 years, and 15 years. And when they go back to 1926 until the end of 2021, so the first day of 2022, what they found was if an investor is willing to hold for only 1 year, they had a 74% chance of increasing their investment, but a 26% chance of decreasing their investment. However, if that investor was willing to hold, okay, for 5 years, so they increased their holding period to 5 years, only 12 of the 92 overlapping 5-year periods resulted in a loss. Therefore, if you go back, you go 80 to 85, 81 to 86, so on and so forth, you had an 87% chance of increasing your account value with only a 13% chance of the loss of money. Now, if you increase your holding period to 15 years, annualized returns, okay, you can see there 100% of the time, you carve out all of those 15-year periods, okay, all of those 15-year periods, 100% of the time there was a gain. 100% of the time there was a gain. So the answer to increasing your odds of success is simple. Increase your holding period. Again, I'll take a quote from Mr. Buffett. If you are not willing to own a stock for 10 years, don't even think about owning it for 10 minutes. In fact, today, holding period in the United States has been reduced greatly. If we go back to 1975, the average investor out there held on to an investment for 5 years. Today, the average investor holds on to an equity for 10 months. Intra-year volatility is completely normal. What you're looking at here is you're looking at a chart of the S&P 500. Many of you know this chart because I've showed it to you many of times. What I mean by intra-year, fluctuations are normal is this. Again, for the simplicity or the ease on your eye, what you have here on the chart is you have the years. So 1980. And this is as of September 30th of 2023. If I use 1980, in 1980, the S&P 500 produced a 26% rate of return. However, at one point during the year, the S&P 500 was down 17%. If I move my pointer to the next year, this would be 1981. In 1981, at one point, the market was down 18%. When I say the market, I'm referring to the S&P 500. It was down at one point 18%. Although not an up year in the market finished down only 10%. In other words, what you're looking at here, the gray bars are showing you from 1980 until current date, what the S&P 500 produced if it's a gray bar to the upside. If it's a gray bar to the downside, it's showing you what it produced for that year, negative numbers. The red dots that you're noticing are at one point during the year what the S&P 500 was down. Now, what I'd like to point out when I say intra-year volatility is normal, there is no exception to the rule. Every single year at one point, the market was down and often down pretty nasty. Okay, pretty nasty, yet still finishing the year in an upward motion. In fact, 32 of the 43 years that I'm showing you here, okay, you produced a positive rate of return. The annualized rate of return in the S&P from 80 until current date has been 14.3%. By the way, earlier I showed you a graph going back to 1926 until the end of 2021, beginning of 22, and I said to you, hey, the market up 74% of the time. Remember I said you get a 74% chance of having a positive return? Well, go ahead and take 43, okay, and divide that 43 by 32. Excuse me, divide the 32 by the 43, sorry, and you'll come out to 74. It's interesting because that first graph went back to 1926. Well, this graph is only going back to 1980, yet we still arrive at that same 74% positive rate of return. Not bad, just as a point. I love this chart. I love it so much, I'm going to show it to you two different ways. What this is showing you is it's saying if you went back to 1990 now, 1990 until the end of 2019, if you stayed fully invested in the S&P 500 over that period of time, remember we're capturing in there the dot-com bubble burst that happened at the end of the 90s. We're also capturing in there 9/11, 2008, 9, where you had the global financial market meltdown, so on and so forth. Well, what you would have earned was 7.7% annualized. However, let's say you missed the best day over that 20-year period of time. You just missed the best day in the market for whatever reason. You weren't invested, you pulled it out, and you were in cash, and you missed the best day of the year. Your annualized return shrank to 3.3. Let's say you missed 2 days. Forget about it, you're at 0.8. You missed 3 of the best days. You were negative 1.8. You missed 5 of the best days. You missed 20 of the best days of the year. Your return over that period was a negative 27. It's very eye-opening. It's very eye-opening. Hypothetical growth of $10,000 invested in the S&P 500 from 1980 until March of 2020. If you were invested 100% of those days, meaning you just never took the money out, your $10,000 that you invested January 1st in 1980 grew to just shy of $700,000, as you can see there. I'm putting it in money terms. It's no different than the last slide I showed you. You missed the 5 best days, you missed the 10 best days, you missed the 30 best days, or you missed the 50 best days. That's what your, in the green bars, what your money grew to. So invest like a farmer. How would a farmer invest? They wouldn't shout at the crops. They don't blame the crops for not growing fast enough. They don't uproot the crops before they haven't had enough time to grow. They irrigate, they fertilize, they provide motivation to those crops. In other words, you could say that, you're rebalancing it. They remove weeds, maybe some tax harvesting. I'll show you a slide on that in a second. Realistic outcomes are not predictable. Sacking the farmer won't help grow the crops, right? There's a process that's involved inside of that. For that, I'll bring up another quote. Investing should be more like watching paint dry or watching grass grow. If you want the excitement, take $800 and go to Las Vegas, as you can see there. Everything reverts to the mean. What do I mean by everything reverts to the mean? On average, what this stock is showing you from 1950 until the beginning of this year, the end of 2022, if you go back and you look at the volatility of the different indexes, in any one year, it is perfectly normal to see the stock market swing from being 39% down to being 47% up. That's in a 1-year period. If you look at bonds, you could experience the same type of volatility. If you look at a portfolio that's 50 bonds, 50 stocks, again, this is over a 1-year. However, when you look at it over a 5-year, a 10-year, or a 20-year, okay, over a 20-year period, I showed you earlier, right? I showed you a 15-year period, no chance of loss. But my point is those swings get much, much, much tighter when you look at them. And so everything reverts to the mean reversion over time. Sometimes I'll have a new client, they invested for their first time 2 years ago or something like that, with the market, the NASDAQ 2 or 3 years ago was up 40 some odd percent. Last year it was down 40 some odd percent, but they were used to that investment in that first year. Well, that's a first year investor. Over time, things revert to the mean. What does investing feel like versus how it really is? The stock that you sold or the stocks that you sell, they always seem to shoot up. The stocks you were about to buy, shown in the green, and of course the stocks that you own seem to do nothing but go down. Obviously, that's just how it feels. That's not how it is. Another slide. If somebody promises you double-digit returns with no risk, what should you do? Run. I get people that email me things all the time. Derek, I got presented with this particular investment. Do you mind taking a look at me? What do you think about it? Geez, I read it and it says, hey, 15% annualized return. There's no lockup. You can get liquidity on your money at any time. Here's how we plan to do it. There's no downside, so on and so forth. Derek, you sent me something that said, hey, you're going to lose all your money. Don't invest inside of this, so on and so forth. The reason for those two things is there's regulations that govern all of these things. If you ever see something like this, run. This is a historical chart. I showed you historical charts earlier of the lines of the stock market, right? You saw a lot of volatility. This is the growth. Had you put $1 into Bernie Madoff's fund in 1990, that $1 would have grown over a 17-year period of time to nothing phenomenally huge, $6.75. But it's just not a normal growth line. Normal growth does not look like that. It just simply does not, okay? The history of bubbles. The history of bubbles. So if we look at it, most of you know 1630s, the Dutch tulip bubble. In the 1700s, we had the South Sea bubble. In the 80s, we had the Japanese real estate and stock market bubble, followed by dot-com bubble, and then obviously the US housing bubble. But what does a bubble really look like? And so what you're looking at here is you're looking at the tulip bubble that happened. For those of you who don't know, this is doomed tulip mania. And so tulips, there was a tulip mania that occurred in Holland during the early and mid 1600s. Speculation drove tulip prices. You can see the valuations, right? Tulips are basically for free. Look at that, right? You had tulips that went so far up in price, people were sometimes forking over 6 times their salary just to get their hands on one tulip bulb. So pretty incredible. And obviously, as you know, as I said, everything returns to the mean. and eventually tulips crashed. You can read all types of entertaining stories, and I could tell you about them, but of course I have to get through 50 slides here, and some of my slides have slides within slides. One of my favorite bubbles that occurred was the South Sea bubble. When I say it was one of my favorite bubbles that occurred, the South Sea bubble is denoted with being one of the first stocks that was ever issued. And so what the South Sea bubble is it began in England, and the South Sea Company was formed. It was formed in 1711 by an act of Parliament where the public and the private partnership were able to go into together. And the whole idea behind it is that they were going to monopolize. In fact, the rule of Parliament was they were going to monopolize the trade between Europe and the US. The stock or the investment, kind of promised to pay a 6% dividend. And what happened is in the 1700s, England went to war with Spain. And at the end of the war, Spain put a whole bunch of restrictions on how much England was going to be able to ship back and forth from the US, so on and so forth. And eventually, this company wasn't making any money. However, what occurred inside of there is King George himself took governorship of the South Sea Company, and the share price of it reached astronomical highs. As it started to reach astronomical highs, those who own the stock way down here, many in government, so on and so forth, were even pushing it. Hey, you got to get in on this. You got to get in on this. You got to get in on this, except for the company basically was producing no profits. And as you can see, an enormous bubble occurred. It occurred over about a 10-year period of time just to revert to the mean. It sounds very much like the stuff we have going on in cryptocurrencies, but that's the thing of bubbles. I bring that up, and I'll also bring up the 10 investing rules of thumb. They're just some simple math things I've been using for years, but I'll just kind of spit them out at you. The rule of 72. The rule of 72 simply says, how long will it take for you to double your money, depending upon the rate of return? So if you earn a 10% rate of return, you will double your money in 7.2 years. In other words, you take 72 and you divide it by what your expected rate of return is, which then brings me to the rule of 114. The rule of 114 is the exact same thing as the rule of 72, except for the rule of 114 says, here's how long it will take for you to triple your money, The rule of 70 is a good rule. And it's the rule of 70 says, how long will it take for your money to be cut in half? No different than you might do the rule of 72. That's how long it'll take for your money to double. The rule of 70 is how long will it take for your money to be cut in half? In other words, you take 70 and you divide it by what the inflation rate is, or perhaps, by what you're withdrawing out of your accounts, okay? And so that is the rule of 70. If I jump down to the bottom of the slide, 10-5-3 rule. 10-5-3 rule basically says this. Hey, on average, stocks are going to earn around 10, bonds are going to earn around 5, and cash is going to earn around 3. The emergency fund rule, I get asked this all the time. How much money should I keep in my bank account? The reason why you may ask how much money you should keep in your bank account is because cash doesn't keep up with inflation. Yes, I know, for the first time in 20 years, cash is finally paying you something. In fact, our money market at Schwab today is paying about 5.4%. So if anyone's inside of tonight's presentation and they got oobos of money sitting in their bank account, you can call me, and your normal bank account today is paying someplace around 3.5, 3.8, maybe even less. You can put that money into the money market with us at Schwab, and you get closer to about 5.5. I've said this on another presentation about 6 months ago. I got a call from somebody right after the presentation. She had $1.2 million sitting in her bank, earning 3.5. We took the $1.2 million, put it in at 5.5. She's enjoying nearly $30,000, $40,000 extra a year. The 100 minus your age, I'm going to skip because I actually don't believe in it. Pay yourself first. For those of you on the call tonight or in the presentation tonight that are younger, I always say this, the most expensive thing that you will ever face is your retirement. The most expensive thing that you will ever buy is your retirement. What do I mean? What do you mean by that, Derek? Well, if you think about it, if you go out, you go to look to buy a house today, I don't care if the house costs $2 million, okay, $2 million. That is not the most expensive thing that you will buy. The most expensive thing you will buy is your retirement. Think about it. You make 100 grand a year today, you go to retire at 65, you're getting $30,000, okay, from Uncle Sam in the form of Social Security. Therefore, you have a $70,000 cut in pay, right? Let's just pretend you live until age 100, so that's 35 long years. That's $70,000 a year that you need to come up with. If you just do the simple math on that, it's 2.5 million. Now, it's not that simple because you'll need a raise every year for inflation. And when you incorporate that into the math, it comes out to something much, much larger. So again, your retirement is the most expensive thing you will fund. Therefore, no different when you go out, you buy a cell phone and a cell phone plan, and you rent an apartment and you buy a car or have a lease or whatever the case may be. One of the most important thing that needs to be on your list of expenses is saving for retirement. That is what is meant by paying yourself first. The 4% withdrawal rule. I get this question all the time. Derek, I'm retiring. I got all these accounts. I got a 401k, I got a 403b, I got a 457, I got an IRA, I got a regular investment account, I got a trust account, I got a joint account, I got a conservatorship account, I got a this account, I got a that account. All of those accounts simply have a label on them so that government knows how to tax you. At the end of the day, what do you have? You have a vat of water called your portfolio. You ever drive by one of these cities and they have one of those poles that has a vat of water on top of it? The reason for that is because that is watering the entire community around it. Some engineer inside of that city knows how much water is inside of that water tower and also knows the water consumption on average of the city. That engineer, he or she knows how long that water will last. When does it need to be filled back up? Well, a very simple rule is if you look at your vat of water, meaning all those accounts, now you went to go retire. Yeah, Derek, I used to make 100 grand. I got 30 coming in from social. I got a $70,000 deficit, meaning I need to draw 70 grand out of my vat of water. Well, the 4% withdrawal rule is simply this. How long will that vat of water last? If I got $1 million in there and I draw out 4, the rule, the 4% withdrawal rule, would say to you that money will last until the day you die, and at the same time give you increases in value to hedge inflation. I think that you can do that better around 6%, but there's a whole unpacking to that. And again, that's my opinion, but that is the 4% rule. Let's move right along. PE ratios matter. PE ratios matter. Don't let me bore you. When you walk into the supermarket, when you walk into whatever you do for work, whatever you do, you know the fair value of things. In other words, I don't know what a carton of milk costs, but let's just pretend a carton of milk costs $3. You walk into the grocery store every week, it's $3. Yeah, I get it, it goes up over time, but all of a sudden, you don't know what a carton of milk costs. Someone says to you, hey, the carton of milk's 25 bucks. I have to pay you 25 bucks. No, if somebody said to you, a carton of milk's $25 and you're used to paying $3 for it, you'd say, I'm not buying it. You're way overpricing it. I get calls all the time from people. Hey, Derek, I really like this stock. What do you think about it? And I look at it much differently because I can evaluate the price of a stock. But I'm going to tell you very easily how you can quickly evaluate the price of a stock. Many of you have heard me say this before, but it's very important because it's back to that. They call me up and I tell them, geez, your stock's like buying a carton of milk for $35. Maybe not, right? Maybe it's not that case, but maybe it is. All that P ratio is the fair value of a stock. Typically speaking, stocks sell at about 16.5 times earnings. What do I mean by that? Well, if a company earns $100,000 a year, okay, the value of the company at 16.5 times earnings would mean that the company has a value of $1,650,000. That's 16.5 times earnings, okay? So when you look at a stock price today, what is its PE? You will find some stocks have PE ratios currently like Hershey's, right? They have a PE ratio of like 5 or 6%. Dollar General, same story until the announcement came up today. Their PE ratio will revert to the mean. The value of the company after hours today, a new announcement came out, the stock's up about 10%. Most of you or clients own some Dollar General in your portfolio. We started adding it in there a few months ago. Why? Because, hey, now that carton of milk's only 50 cents, right? So yeah, buy as many carton of milks as you can. But you look at P ratios, and sometimes somebody calls me up and I say, well, geez, the P ratio on that company today is at 100 or it's at 50. It's just a very expensive stock to buy. Stocks tend to revert to the mean. By the way, on September 30th of 2023, forward P ratios of the S&P 500 were a tad above the norm at 17.83. There's your 25-year average. I know I said 16.5, but the 16.5 is giving you an average all the way back to 26. Let's keep working here. Although PE ratios are very important, the key driver to long-term stock performance, or the key driver, heck, the company performance, has been revenue growth. In other words, that company continuously increasing their revenue. And so again, you may have a company, let's say like Hershey's. I said it earlier, I'm not recommending Hershey's or anything like that, by the way, but what I'm saying is the company right now today is very lowly valued. What does their revenue look like? Are they selling more Hershey bars this year than they did last year? Are they selling more of their products? So you can see a company's growth. That has been overwhelmingly the number one thing to grow stock price, a growing company's revenue, okay? New investor mistakes. Only buying hype stocks. You see Tesla inside of there. They sell on the first drop. Hey, geez, this thing should only go up. They're not reading investment booklets. They just simply, they're not really taking the time to learn anything. They're simply hearing things on social media or on YouTube, so on and so forth. Not diversifying. Diversifying is mixing your investments among different asset classes that do different things. Thinking low P ratios are always a buy. My last slide maybe made it sound like that, but sometimes you have a company that has a low P ratio. Why? Because their revenue is going down. Only buying tech stocks, as you see, is one thing. There's a lot more that goes into it, okay? Let's keep going. The Gardner hype cycle. What is Gardner hype? Okay, I want to spend a second on this because I do think it's important to understand. Potential technology breakthrough kicks off. Early proof of concept works out. It triggers significant publicity and significant interest by the public. Often there's very few usable products that exist, and commercial visibility is very unproven. In other words, hey, this would be great, but is it really going to work out, so on and so forth. It starts to become more visible pretty immediately. We then hit a peak of inflated expectations. Hey, this stuff was supposed to be the new whatever it is. And we also get a bunch of success stories. Oh my God, this person became a billionaire by getting in early on whatever the new technology is. Some companies even take action. Some companies even form new businesses around it, but many don't. Through disillusion, interest wanes, and experiments and implementations fail to deliver what was originally promised when that technology was first talked about and first supposed to change the way we lived. Investments continue, and there are some survivors in that. And over time, you see this times, going out, these new wave future technologies do start to take some ground, and things then start to slowly develop, but never back to the peak expectations of it. And that slope is more interest that finally kind of tapers out. Now, with that said, realize companies are competing all the day. So when we look at the adoption of technology in the United States from the 1900s to present, we generally see an S curve. In other words, a huge upslope in the adoption, and then that is followed by a flattening. And so when you think about it, even think about yourself, right? You think about social media, you think about a cell phone, you think about a smartphone, you think about credit cards, you think about tablets, so on and so forth. I mean, I was having this conversation with somebody the other day about Amazon. Amazon, for those of you who are thinking, well, Derek, didn't Amazon always have a negative P ratio because they never earned any money? And so if you're only looking at companies that have positive revenue, Amazon didn't have that forever. And oh my goodness, what a miss, right? Because you wouldn't have bought that on the slides that I just showed you. But my point being is, for every Amazon, there's 2,000 companies that failed. Okay, they failed and you never heard of them, right? They were never worth investing in. But my point in saying that to you is this: I can't imagine 20 years ago buying something online and trusting it was going to come and be in good shape. I exclusively buy things basically on Amazon today. So the adoption of technology takes off. Companies tend to invest. Why? They want to be first to market to put that into place. We tend to invest, but realize in a lot of those things, there's a lot of companies that are producing product and not all of them survive. Phases of a bubble will also show you this. You know, the 1929 bubble, the 2020 bubble, and the 2017 Bitcoin bubble. I don't like cryptocurrencies for many reasons. I wish somebody could change my opinion on it. 1929 is a little too long ago for most of us to think about. So let's focus in on the 2020 dot-com bubble. When you think about it, you see this chart. It says smart money, institutional investors, the public, and then you see the blow off phase. So smart money, I don't know if I necessarily love that phrase, but smart money will tend to get in when things are, oh, I can see an application for this. Institutional investors is a lot of what we do, or bigger money centers. Oh yeah, there is an application to this. We're already reading reports of companies adopting it, okay, so on and so forth. When it hits the public then starts to get very excited about it. They start to invest money inside of it. We start to see those things start to shoot up. Remember, everything reverts to the mean. We see risk when this starts to occur. And you know, you have things that revert to the mean. So the dot-com bubble, think about that for a second, right? You had that dot-com bubble burst. You had companies in there, PE ratios at the time that reached north of 300. It was absurd. I was getting into the business right around here just to watch this all collapse, and a reversion to the mean always happens. It's just a rule. The bigger the loss, okay, the bigger the loss, the bigger the gain required to break even. Let me put this chart into one simple word. You have $1. You lose 50%. Therefore, you only have 50 cents left. How much of a gain do you need to get back to even? Well, if you have a 50% gain, you only get to 75 cents. If you lose 50%, you need 100% gain to get back to $1. So big losses can be catastrophic to portfolios. You notice here, you got a 70% loss. You need a 233% gain just to get back to even, okay? Inflation. Inflation is something that's working against you every single day, the erosion of your purchasing power. I'll never forget when I first got into this business, I literally had a woman say to me that she keeps all her money in a shoebox underneath her bed. Now, forget about the shoebox being underneath her bed. She should at least have it in a bank, because her insurance policy doesn't cover that shoebox of cash if her house burns down. But the point being is, every day, every year, every hour, consistently, she is losing money. Not to say that there's money falling out of the shoebox. She got 100 grand in there. She takes that shoebox out 5 years from now. She counts that. There's still 100 grand in there, assuming, you know, her kids didn't find it and steal some of it, or her house didn't burn down. Point being is, $1, okay, in 1913 bought you 30 chocolate Hershey bars. $1, 30 of them. Today, wholesale price, $26 for those 30 Hershey bars. So you need your money to grow north of inflation. Okay, that's one point. Realize this: what is EBITDA? EBITDA stands for earnings before interest, taxes, depreciation, and amortization, okay? It's a measure of the company's operational profits, okay? Net income is what's left over after all of those things. So don't be fooled. If you start looking at things, you want to look at net income because it's very important. The impact of taxes, this is quite crazy. This is the compounding effect tax-free. If you take $2 and you double it to 4, double it to 8, double it to 16, 32, okay? What would happen is it would accumulate to $1,048,000 if you simply compound it 20 times. It's quite amazing. Albert Einstein said, the most powerful thing in the world is the combination effect of numbers. That's what you're witnessing there. But now look at if that is taxed at 25%. Well, that 1,048,000 is now only worth 72 grand. You know, clients talk to us all the time about fees, and you know, fees typically range someplace between 0.80 up to 1.75 or something like that inside of portfolios. What they don't realize is what's affecting them mostly is taxation, right? I'm showing you a 25% tax bracket there. Look at that, million's only 72. It's crazy. But realize most people inside of tonight's webinar are at a tax bracket of 38 or maybe even a little higher. Well, there's things you can do with your investments to help protect yourself from taxes. You don't think so for a second? Let me show you one other slide. I started with this slide a little bit ago, okay? And the slide that I started with was this. I showed you, hey, here was from 1926 in the stock market, right? There you see that small cap growing to 56, growing to 14 in large cap stocks, right? By the way, what I was saying earlier is they don't go in a straight line. That's volatility, up and down, up and down, up and down. Let's slap taxes on top of this. Let's slap taxes on top of this, okay? If I slap taxes on top of that and I take a peek at it, what you're looking at here is now all of a sudden, right? That stock rate of return doesn't look nearly as impressive, only 2,570. Point being in all of that is you can be very particular inside of your investing strategy as to what accounts you're not going to face taxes inside of, what accounts you will face taxes inside of, and then something that for those of you who are on the call that we've done for you for years is tax harvesting. I know when I explain it to you one-on-one, you're like, what are you talking about? But we save you dramatic amounts of money by doing tax harvesting versus not doing it. It never shows up in overall portfolio return, but of course it's a good thing. Back to my good friend Warren Buffett, typically someplace around the richest person on the planet, but realize, Mr. Buffett is an older man, but take a look at his net worth. At 33, he's worth 2.4 million. At 43 is worth 34 million, right? Like 34 million, it's a lot of money, but not billions. At 83, but that's the compounding effect of money. You saw him in his retirement years, he's worth 3.8 billion at 60, but look at what happened thereafter because of the combination effect of numbers. It's, again, as Albert Einstein said, one of the most powerful things in the world. So don't think that things don't take time. It goes back to watching grass grow, so on and so forth. 40 years of interest rates, 40 years. So we go back to 1973 and we look at where interest rates are. If you see this here, we go back to 43, we see interest rates were at 7.5. We saw interest rates shoot all the way up to 18% as we were in the early 80s. We saw interest rates come down, 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 down. And obviously, as most of you know, we're seeing interest rates going back up. Federal funds rate right now, 5.5%. I think they raise in November, although I'm a little weaker in saying that. I've been right about every raise that I've said to you over the last few years. This one in November, the only thing with the Israeli Gaza stuff going on, the Fed may kick the can if I eliminate that from the equation. Although TV and the headlines prior to what's going on in that area of the world was saying that they gave it a 50-50. I gave it about a 90-10, 90 yes. I think some of the data that came out over the last 2 days would again say that the Fed would increase by 25 basis points. That said, we are still in an extremely low interest rate environment, and there's been plenty of times, although you see this line going down, there's been plenty of times where the Fed has risen interest rates. And again, what's the market done over those points of time? So the fact that interest rates are going up is not necessarily a reason not to invest. It's just where we are today. Signs that we're at the top of a market or signs that we're at the bottom of the market. Signs that we're at the top is a large number of companies IPO. Why? Because, hey, they probably believe worse times are ahead of us. Let's go ahead and IPO today. And typically you see a slew of bad companies IPOing. When I say bad companies, I mean companies that don't have that net income, right? They're not earning money. Rapidly rising prices. So when I read this, I think about this. Right now, we are in one of the lowest IPO raising areas that we've been in a long, long time. Okay. However, we have had rapidly rising prices. We see extensive leverage. In other words, a lot of debt on a lot of debt out there. We see that today. We see leverage going up. Availability of credit. Banks are willing to loan. We see some tightening of that today, but we've obviously seen some pretty easy credit out there. Overly optimistic front covers of newspapers and magazines. I don't know if we have that so much. Very high trading volumes. Trading volume is very high, but I don't know if that in and of itself means anything. Historically high P ratios. Interestingly, we're a little frothy, as I showed you, but we're not any standard deviation out of the mean. Art and luxury markets booming. We saw some of that during COVID, but that's somewhat dried up. Financial press and financial TV becoming more favorable. I feel like the financial news today is kind of flat. This time is different declared. No. Amateur investors move to equity assets. We already saw that 2 years ago. Innovation leads to utopia. We haven't had too much utopia. Last year, markets were down pretty severely. This year, they started off with a bang, although, the Dow Jones Industrial for the year at the turn, at September 30th, not the turn, but the third turn, Dow Jones was up just shy of 1%. So, not too much utopia going on out there. Social proof leads to herding. I think we saw that a few years ago. Signs that we're bottoming. I won't read all these to you, but I'll skip through them. No mergers and acquisition. We don't have any mergers and acquisitions occurring today. No IPOs. Like I said, it's the thinnest IPO market that it's been in 50 years. New money or venture capitalism. There's not a lot of it. That is true today. Sale price, EBITDA multiples are lower. That is true today. I can give you examples of a million different companies out there that are trending below average PE ratios. Central banks not easing. Obviously, the central bank's raising rates. That's talking about the Fed. But I think we will get into an easing environment 6 to 12 months from now, probably 8 to 12 months from now. And you see, recession declared officially. We haven't had that. We have a really strong labor market. But anyways, those are bottom signals. I probably spent too much on that slide, sorry. But we're getting to an end here. We got a few more slides to rock and roll through. Again, as I showed you here, look at 2009. This is, in bad markets, good companies go public. Now listen, don't read that wrong, right? 2008, 2009, you're probably thinking, oh yeah, that was a bad market. No, markets didn't get bad until about June of 09. I know we call it the 2008 global financial crisis because that was kind of the onset of it, but the market, meaning the stock market, didn't start to fall off a cliff until mid 09. So look at all those companies, right? And look at where we are today. I mean, today, I don't show you 2022 number, but 2022 number is extremely low. So what I mean is in a bad market, good companies go public, right? Strong companies can still go public in a bad market. It's not like we've dried up today, but a lot of the companies we have IPOing today have very strong balance sheets versus what we had back during the dot-com bubble, right? Where bad companies. Listen, in the short run, and this is the second to last slide, in the short run, Stocks go all over the place, and they're driven by the news. They're driven by trends. They're driven by liquidity. You know, what's the American consumer? Do they have extra money in their pocket? What's going on with inflation? What's the market sentiment? Unemployment drives stock price, right? Trade wars, GDP, interest rates, supply and demand, all of that drives stock price over a day, a week, a month, 3 months. Again, what drives stock prices over time is consistent revenue. Okay, that's what drives it over time, but this is what drives it over the short term. The sooner you invest, the better you are. In other words, let's say you plan to retire at 65 and you'd like to have $1 million by that time at a 6% rate of return. So why we use 6 in the slide, I don't know, but 6% rate of return. How much would you need to save each month to get to $1 million? And of course, it depends on when you start. But if you start at age 20 and you save $361 a month, okay, until 65, so 45 long years, every month you saved $361 over that 45-year period of time. What you ended up saving over that period of time, all the dollars that you saved 195 grand. That's it, 195, but it grew to $1 million. If you didn't start saving until age 30, now you have to save $700 every single month in order to get to that $1 million. And at 40, $1,400, and at 50, $3,500 a month for 15 years you'd have to. So starting to save early makes a big difference. And by the way, right, if you want to do the quick math, remember, this person only saved 195 grand. You'd probably say, hey, listen, when I'm 50, right? But if you think about it, $3,421.46, right? For 15 years. This person actually saved $615,000. So they had to put away 615 grand to get to $1 million. This person only put away 195. Why? The combination effect of numbers. That's the 50th slide. And again, that's at a 6% rate of return. Typically, we'd open up for your questions, but you guys can email them, you can call me, you can do. What we do very quickly, we analyze your situation, we help select suitable investments, we help set realistic expectations for performance and planning, so on and so forth. We monitor the portfolio, we manage the money, we tax harvest it, we educate you on these types of things, so on and so forth. You can schedule an appointment with me if you'd like, if you click that link, but you can't click it. So you can go to our website and find my profile. You can schedule there. Listen, until next time, I thank you all. Triumph Capital Management, myself, Derek Eichenwald, thanks for paying attention. I think I went like 4 minutes over the hour. But thanks again. Let us know if you have any questions, and I will look forward to talking to all of you in the future. Thank you. Have a good evening. Go Broncos.